Two, one. We are live. Hello and welcome to wealthlessons.club and productlessons.com. Actually, I have two podcasts, by the way. Wealth Lessons, as the name suggests, is on investments, angels, funding, deal flows, businesses, and wealth creation topics in general. Product Lessons is primarily on software product conversations. I'm a product guy, so I started Product Lessons, then I opened the other podcast on Wealth Lessons, and I will publish today this podcast on both the channels because we are going to have conversations on the product side on a very interesting topic, and then also on the investment side. I'm thrilled to have with me a guest whom I knew through Upscalers Angel Community. In a recent due diligence conversation we had with a bunch of startup founders, I found him to be sharp and perceptive with his questions. He doesn't mince words. He calls out bullshit from the best looking pitch decks. So I thought he's smart. He has the wisdom and knowledge, which seems has been acquired by a lot of experience in the past. That's when I decided to invite him as a guest. So we are here. But before welcoming him, let me read out his formal introduction. So Samir Singh is a startup advisor and early stage investor focused on network effects. He's a creator of breadcrumb.vc, and we're going to ask during the conversation what it is. And Applied Network Effects, one of the highest rated courses on Maven. Both are globally renowned resources to learn about network effects. Samir also is part of the Atomico Angel program, where he invests in early stage startups with network effects. He has 14 years of experience in the technology ecosystem, distributed between technology startups and investing. For much of his time, he studied technology business models and network effects in a professional capacity and via independent projects. He has spent 5 years at App Annie, a Sequoia funded late stage startup during its hyper growth phase. There, he led a global cross functional team working across product, marketing, and sales. He advised leading tech companies like Spotify, Spock, and Trainline. Before that, he was an early stage investor focused on commerce businesses. He has been quoted and mentioned in leading publications including Reuters, Sifted, Business Insider, The Guardian, TechCrunch. His prior independent work has been referenced in Philip Tetlock's book, Super Forecasting. So as you can see, we have a great guest today. So without further ado, let's welcome Samir. Samir, welcome to wealthlessons.club. How are you doing today?
I'm good. Thank you for inviting me, Ravi. I'd always love having chats about product and investing. And so it's great that you have a podcast focused on both. I didn't actually know that.
Yes, I have two, and yeah, and network effects is something that is super fascinating, and I have had guests speak on this topic before, but I think you would be a special one as well. Before we get into network effects, why don't we, since you have so much of experience in the world of investing, why don't we start with how did you get into the world of investing? Is this something that you had planned, or it happened?
It was a bit of both, really. So it's a long story. Originally, I was a quote unquote investment banker, a very junior investment banker back in India. This is 2011, 2012. And on a whim, I started writing a blog about mobile businesses and ecosystems when iOS and Android were duking it out because I thought it was fascinating. And that became a bit bigger than I thought it would be. And honestly, it taught me how to write. And accidentally, I ended up at a, a quote unquote venture capital firm in India. And I say quote unquote because this is 2012. There were no real venture capital firms in India back then. This was a family office um, uh, with one of the sons who had created a tech company. I was interested in creating a rocket internet equivalent,
Ah,
but turned out incubation was hard. So we ended up investing a little bit. So that really was the first time I accidentally got into investing. And since then, with my blog, ended up at the startup called App Annie. Spoke to loads of consumer businesses because that's essentially who App Annie sold to. Ended up getting deeper and deeper into network effects because that's essentially what every consumer business was built on or was fighting against, at least the most successful ones. And then after App Annie, that time it was more, I wanted to deliberately get into investing, but I didn't actually have too many avenues. So I actually thought at a month before the pandemic that let me kind of write a few blog posts about network effects. I have some ideas, and ended up writing for a year. And that's how I ended up at the Atomico Angel program and been doing more and more in the investing ecosystem since then.
Nice, nice. Um, so I'm a generalist, and I envy people who are good at one thing. Your expertise, your superpower is network effects, right? You have a popular course in Maven, which sells by itself, is what I heard. How and when did you decide that I need to be an expert on network effects?
It was again very organic. So what happened was when I was writing the initial blog on mobile businesses, I'd occasionally come across companies that had some form of network effect. Facebook, for example, this is when Facebook was heavily criticized when they were a private company. They had a down round. WhatsApp, the WhatsApp acquisition. So I started dabbling in it back then. Nothing in sort of detail or in depth, but just sort of got a bit more of an interest in it. And then I ended up writing a paper on business models with this company called Vision Mobile. It's called Slash Data now. It was a telecoms ecosystem analyst firm that was based in Europe.
Right.
And we got a bit deeper into it when over there. And then after I joined App Annie, someone from Vision Mobile, he wanted to do an independent project on network effects. This book called Platform Revolution had just come out, and sort of he had some ideas on what we wanted to do. So we tried to categorize the different types of network effects with some project called Platform Hunt. Right? That was informative. It wasn't really a very popular project, but it was informative for me. And so I actually fed a lot of that work back into my day-to-day work at App Annie. Because at App Annie, I was the head of consulting for the last many years. Basically, App Annie had market data on pretty much every consumer-facing app at scale in the world. So a lot of customers sort of walked in and didn't really know what to do with the data. So my team's job was to go talk to them about, okay, what struggles do you have with your product or your growth? Based on the data we see, this is what you should be building, this is where you should be growing, etc., etc. And a lot of that, I ended up leveraging the work from Platform Hunt in there to make sense of it. And so by the time I had left App Annie, network effects were pretty much the core of what I had done for the last 7 years. It was the only common theme because it started with sort of mobile businesses, iOS, Android operating systems fighting it out. Then sort of Facebook, Uber, Airbnb, all of these different consumer companies that we were looking at. And it sort of was a natural outcome at that point when someone asked me what were you interested in. I'm like, network effect, obviously. It wasn't obvious to anyone else, but it was obvious to me because of what I'd been doing for the last 7 years.
Got it. Got it. You mentioned about Platform Revolution. So so one of the co-authors of Platform Revolution is Sangeet Paul Chaudhary. I
Mhm.
had him on my podcast twice. I've met him in a couple of occasions. I would not say we are friends because he's far outside my league, but we know each other pretty well. And yeah, so that's where, I mean, so his concept of platform is beyond products now. He considers countries as platforms. So he's consulting the Singapore government to make Singapore as a platform. I think he's also now in Dubai doing the same. So yeah, thanks for referring that. So for the audience who might be new to network effects, a simplistic definition that I have learned, I mean, is the value of a product or a platform is directly proportional to the number of participants or users in the platform. The more number of users and participants in a product or a platform, the more valuable the product becomes. Like, say for example, you have a phone. If you just have one phone in this entire world, it's of no use. If you have the other person having a phone, then it's definitely valuable. But the more people engaged in that network of communication, the more valuable the communication becomes, right? So this is a simplistic definition of network effects. Could you elaborate more on what else is the potential of network effects when it comes to building products and companies?
Oh, well, you got the definition of it right, in the sense that adding a user makes the product more valuable for all users. I think the challenge is every time you try to apply that to a real world company, it starts getting complicated because there's lots and lots of different threads and nuances that happen. So the definition you mentioned, at the start of my course, that there's one slide with just that definition, and the rest of the 3 weeks we're basically trying to squeeze in that definition to every individual company and see what happens.
Got
So in real terms, if I had to simplify it, you've got 4 different buckets of network effects. Right? You've got data networks where and the addition of a user helps you collect more data from the product, and more data increases the value of the product for all users. Right? You have interaction networks where you're connecting users to each other and enabling ongoing interactions and direct information exchange. So it's a non-transactional interaction. You've got marketplaces where you're matching 2 or more distinct types of users and allowing them to buy and sell something, a product or a service. And finally, you've got what I call a platform. I think that is a heavily abused term, but I try to use a very narrow definition of it, which is you're allowing software developers to build applications on top of an existing product and then connecting those applications to the users of said product. Broadly, I'd put them in those 4 buckets. There's more complications because within each of those, you will have more subcategories, which makes network effects stronger or weaker, more scalable, less scalable, more defensible, less defensible, and sort of the factors will change based on each bucket.
But you mentioned data networks, interaction network, marketplaces. What is the 4th one? Did you say?
Platforms,
right? Okay. And you mentioned briefly. You said I try to squeeze in how can we bring network effects to just about any company. So are you saying the principle of network effects can be applied to just about any company, or there are?
No. What I was talking about is specifically applying the definition of network effects to a real world example of a company that has network effects and see all the complications emerge from it, where it's not always a clean application, right? So for example, Uber versus Airbnb. Yes, adding a driver makes Uber more valuable for all drivers. Adding a host makes Uber more valuable for all guests. But somehow, adding more hosts has made Airbnb significantly more valuable over time, whereas adding more drivers has only had an impact for until the wait time hits 4 minutes. Right. So there's certain characteristics that create those divergences, and that affects the scalability. In this case, that affects the defensibility of the network, and there's other things that would affect the scalability of the network in question.
Got it. Closely related term is equilibrium, right? When you talk about it's like maintaining if there are 2 parties, so there is a service provider and service receiver, right, in a platform, so to say. So when you talked about Uber, you talked about there is the drivers and then there are the passengers, and then there is a concept of building an equilibrium. That means if there is a shortfall in one of these players, then this entire network effects falls or fails. Is that something that you are also hinting towards when you?
Yeah, I mean, I'd call that liquidity. I wouldn't call that equilibrium in particular because of a few specific reasons. One, liquidity basically means how many users do you actually need for this network to have value, right? So that's the point of critical mass. Once you reach that, you still need to maintain liquidity, but it's less of a problem than it was before you reach this point. That's called what's commonly known as the cold start problem. Now that will affect any network, whether you are highly defensible at scale or not defensible at scale, or if you are highly scalable or not highly scalable, it would still affect you on day 0. So that's sort of a generalized principle. There's going to be a few factors that will make it easier or more difficult to reach liquidity. So for example, if you've got your network which is highly localized, you need to basically build up critical mass in every single region, like Uber, right? They scale in Soho, then they go scale in the suburbs, then they go scale in a different city. So it's almost like building a new startup again and again. Right. Whereas an Airbnb is you scale and then you basically cater to demand pretty much everywhere. Got it. And so it affects different types of marketplaces and different types of networks differently. And again, this is also where you will see the type of network will define what makes it hard and what makes it easier to reach liquidity.
Got it. So earlier you mentioned that everybody gets the definition, but when you apply that into your business, it's a hard problem to solve, or it's a hard thing to implement. Yeah. What do you think are the challenges for applying network effects into a startup?
Well, the first one is that people mistakenly assume that, quote unquote, companies have network effects, or some of the smarter people go, products have network effects. Both of those are wrong. Neither of those have network effects. Interactions have network effects. So when you have a specific interaction between two users on a product, whether they are the same roles or different roles, it is that interaction that creates the network effect. And so if you want to create a strong network effect, or rather implement the network effect correctly, depending on whatever the interaction is, you need to have a very deep and specific understanding of the interaction. And this is even more important if you're an early stage startup, because you're going to live or die based on your understanding of that interaction.
Okay. Could you specify that with some startup examples, maybe? So let's go through some of the startups that you have invested already, right? So maybe that would be good examples.
Yeah.
So you said that you have invested into, how about Lapse, Smitten, Anyone, Timico, and New? Because you said you exclusively focus on startups with network effects. Could you give examples along
Sure.
with this? Yeah.
Sure. Let's use HubBot as an example. They were my first investment under the angel program. So the whole premise of HubBot basically is that you're trying to figure out when you can get your friends together for a beer, and you have a group chat with your friends. If you try to organize something on that group chat, it's a complete mess, because some people reply immediately and go, I'm free then, I'm not free then. Someone replies 2 days later going, I can do Thursday, and by that time the other goes, I can't do Thursday. And so it's the wild west when you're trying to do that. So the premise of the founders was there has to be a better way, and so their idea was stitch people's calendars together. So essentially, once you add a friend on HubBot, your availabilities are accessible to each other. Just like, for example, if you work in the same company, you can see when your colleague is available and book a meeting with them. You can't do that with your friends. And essentially, you have a group chat or a chat interface built on top of that. So it's almost like stripping out a verticalized use case onto a separate product. So the way an interaction would work on HubBot is, and they define people as planners and basically attendees, right? There's always people in a friend group who are more likely to get people together, and other people who just show up and are less likely to do the actual planning. So when a planner goes in, there's a big plus button in the middle. He opens it, opens up new interface. They add their friends. They immediately see who's available when, and they go, this time seems good for everyone. Tap it in, add whatever details they want to, and because it's sort of a social app for younger users in particular, it's very GIF based, and you send it out, and there's a group chat interface in there with polls. So for example, you want to figure out, do you guys want to go to bar A, B, or C? Do you want to go eat pizza, Thai, or Chinese? All those polls happen in there. And that's basically how the entire interaction works. And the first time I spoke to them, they had a very specific understanding of the interaction. They had ideas of where they could take the interaction, but as of today, this is the core interaction they're going to enable. And some of the things that you want to look at in the early days is, now the definition of a network effect is adding a user makes the product more valuable for all users. Theoretically, that looks fine, but in the early days, that would mean that if you're adding more users, people should be doing more. Otherwise, how do you ascertain that it's the product value is increasing for all users? So they had this chart. I was looking at the average number of events planned per user and the average number of essentially attendees who've said yes. And the chart was basically this. At that point, their average users they had 5,000 to 7,000 users. They weren't growing. It was in the middle of the pandemic, right? So people aren't really meeting others. I looked at that engagement chart. I was like, yeah, I mean, right now, back then they had a grand total of 150,000 plans that people attended. They just hit 2 million yesterday. They've basically grown by about 10 or 15x. And up until now, they haven't raised VC funding. So there'll be some updates there going forward. But up till now, they hadn't raised any VC funding whatsoever.
No, so help me understand, how is it a network effect? Because you make plans only with your close-knit community, right? So,
yeah. Well, close-knit community. Think about the kind of community you would have, right? So you're not only ever meeting the 3 friends you have, right? You'd meet your 3 friends. You'd meet parents of your kids. You'd meet people you meet occasionally. You'd meet people from work, outside work. You'd meet your ex-colleagues. So you've got your close-knit network. You've got your slightly expanded network. So there's lots of different people that you connect with and plan with and go to meetings with. So their virality is through the roof, because if you plan an event on HubBot, you can basically send that link to someone who's not on HubBot on a WhatsApp group, and they come in. So their average what we call the word of mouth coefficient is about, for every 2 users on Hubbard, they get one new organic user, something like that. And so that's the virality bit of it. But as those users come on, it becomes more and more useful. So pretty much you default to Hubbard when you're trying to get together, as opposed to defaulting to WhatsApp.
I
Because
think
if all of your, yeah,
this is similar to Calendly's virality as well, isn't it?
the
Calendly,
virality bit, yes, but Calendly doesn't have a network effect. It only has virality. Because if you have Calendly, it doesn't affect my value from Calendly.
I see. So here, adding, so there is more serendipity to occur here because there are more people. So you increase your chances to be invited into a meetup or something. Is that how it is the value?
It's for the planner. So once your friends are on Hubbard, you can actually see their availability, and so the actual finding when to meet up immediately goes away, and then the actual chat happens on Hubbard. It's far easier to do it there once they've actually narrowed down when and where.
Got it. So this would fall under the interaction network then, the
Yes,
second one.
yes, bingo.
Excellent. Okay, maybe a couple more.
All right. So the second one is called Lapse. This is also a social network. After this, I should probably give you a non-social network example. But
Mhm.
Lapse is the idea for Lapse was that existing social networks like Instagram were originally built on your social graphs that in that you saw posts from your friends. Increasingly, they become more influencer driven. You don't really see stuff from your friends. You see stuff from influencer XYZ who's doing something interesting or unusual.
Right,
Um, so the idea of Lapse was, how do you get back to friends, not the model of friends, not followers.
right.
So their idea was, what if the picture couldn't be perfect? If you're an influencer, the picture you take has to be perfect in some way. There's filters. There's 10 different photos taken for the perfect right pose, right? Yeah. So with Lapse, when you take a picture, um, one, you can't see the picture until the next day.
Mm-hmm.
Two, you could only take pictures in closed groups. So you go into Lapse, you create a group of 3, 4, 5 friends, and all
Mm-hmm.
of you have a photo roll of 36 photos, and
Mm-hmm.
so everyone in that group takes photos from that roll, and any photo that's taken essentially disappears for 24 hours. No, even the person who's taken the photo can't see it, and it
Mm-hmm.
shows up the next day. And so it's basically in the moment. The idea for it was almost like the disposable camera that you need. Dispo in the US also tried to do that, but they didn't do the closed group social graph based thing. It was very, very broadcast oriented, whereas Lapse is very social graph oriented. And so they hit number one on the App Store back in October of
Mm-hmm.
last year when they launched. And now they're again building a few updates in stealth, which are probably going to be interesting to see for folks a bit later on.
Got it. Cool. Could we pick one more maybe?
Yeah, okay. A non-marketplace. This one is called New, N-U-W.
Uh-huh.
Sorry, this is a non-social network. So the idea for New was, I mean, people buy lots and lots of fast fashion, right? From H&M, from Zara, from places like this, and occasionally people try to sell them on resale websites like Depop and Vinted.
Mm-hmm.
The challenge is, because people don't really value these products because they're not especially expensive, you don't really have the motivation to discuss the actual price of it and figure out what the actual price should be with someone who potentially wants to buy it, right? So let's say you put it for £10, they go, actually no, I want it for 7, which is kind of annoying for for most people. And so the sell-through rate on a company like Depop is just 10%,
Right.
which means 90% of things that are listed on Depop either stay in people's closets, or they end up at a thrift shop, or they end up in the trash.
Got it.
So the idea of New was, these clothes are still good, but they're not being used in that way. So their idea was, let's take the friction out of it. So the way New works is, you upload a listing just like you would on Depop, but you can't price it. You can't say this costs £10 or £100. The moment you upload it, they approve it on their end, and they give you a gold coin or a silver coin. It's not crypto; it's just sort of a virtual currency within the marketplace.
Got it.
And once you receive that gold coin or that silver coin, you can go claim something else from somebody else has uploaded.
Correct.
So it's almost like you upload something to the marketplace and you take something out of it. And
I
so
see.
again, in their case, their retention and engagement was through the roof. They've got the average user does this 4 to 5 times a month, and their, I think, retention was in the range of 60% after 6 months.
Right.
Uh, so yeah, once people start doing it, they get hooked, because it's almost like a rotating wardrobe for you then, and all it costs is like £1 every time you claim something.
Right. So have you? So since you work with so many startups, um, does the concept of network effects come as an afterthought, or do they envisage problem solving with network effects as the core of their offerings?
So when they're coming up with the idea, at that time they're not thinking of network effects. Normally,
Mm.
when they start implementing the idea, generally,
Right.
is when they run across some challenges, and when you start researching those challenges, they basically stumble into this giant world of network effects. And so by the time they've spoken to me, uh, they're really looking for some type of insight or support on that front, because network effects are something that's, if you're building a company like that, it's pretty much the core of your company. Everything you're doing in product or growth or your metrics basically points back to network effects. So they very, especially the best founders, very quickly ramp up on the fact that this is very core to them, and they need some sort of support, seek out advice, because being a founder is a very sharp learning curve, and so the more support you get, the earlier you get, the better for you.
Got it. So has it ever happened that you spoke to a founder and he never realized that he is operating in a network effect, and you told him, "Hey, this is it. You need to leverage this."
Not so far.
Mm.
I've come across founders that where they were aware of it, but they weren't too deeply immersed into it, or
Right.
they weren't especially curious about it.
Got
And
it.
so those are things that I look out for when when I'm trying to invest into a company. In general, curiosity is extremely important. And so
Got it.
even if they weren't deeply aware of it, the moment they become aware of it, you see them becoming ever more curious about it. That's really what you want to see.
So the reason you look out for network effects is not because you're fascinated by network effects, but you see the big upside to network effects because of few reasons, right? Like defensibility. It's a flywheel. It's a virtuous loop. It gives you enormous advantage over another business which does not have. Maybe could you just list out a few advantages of building a network effects startup?
To first answer your question, the reason I focus on it is also because it's my personal interest area, and especially now, if you're trying to get into venture, being a specialist is better both from a value add point of view and a brand point of view. It's very
Mm.
hard to establish yourself as an investor, as another generalist investor, of which there are quite a few successful ones already. So it's really hard to stand out. So for me personally, it would make sense because my interest and my brand are aligned. But in terms of why they make good investments, I mean, there was a study by NFX a long time ago which said that about 67% of all value created in tech since 94 was attributed to network effects. And I think that's very true. It comes down to really two things. If you're really thinking about it, one is scalability, in that you don't need massive amounts of capital to grow.
Mm.
I mean, think about how much a company like Airbnb took to grow versus a company like that's very capital intensive, like WeWork. You can actually see the huge difference in capital requirements. The second is, and also your unit economics tend to get better as you scale when you have a network effects business. Whereas if you don't have it, there is scope for them getting worse over time.
Got it.
What doesn't always happen that way. Operations execute, and there's something to say for operational execution, but there is scope for them getting worse. The second, potentially related to the last point, is defensibility. Not all network effects have strong defensibility, but the ones that have strong defensibility, they tend to have a significant advantage, because essentially they're not going to run into CAC issues at scale. where there's competition that's shown up, and all of a sudden your cost of customer acquisition is skyrocketed. Your LTV goes down because of potential customer churn. Those issues don't exist with companies that have very, very defensible network effects.
Could you,
Um,
expand on that? Because what you said is not all network effects companies have high defensibility. Is that what you
yes.
said?
Yeah. So
And
the case studies I always start with, because everyone has used them, is Uber and Airbnb. They're both marketplaces. They were both called "quote unquote" sharing economy companies, which is a completely nonsensical term, but it's used by a lot of people. Uh, if
gig
you
and yeah.
Yeah, so if you look at essentially repeat purchase rates at Airbnb, they're sky high. How much competition does Airbnb have for what Airbnb is doing? Even today, it's fairly minimal. Uh, right now, Booking.com and sort of Expedia and companies like that consider Airbnb a threat. Whereas with Uber, you've got loads of different ride sharing companies, all in the same market as Uber. So here in the UK, you've got Bolt and Uber that are both at scale. In the US, you've got Lyft and Uber. In Asia, you've got Didi and Ola and Careem. There's at least one or two local competitors everywhere, and they're largely at the same level.
Right.
And the reason there's not more is because they've basically run out of cash, and investors are kind of scared of burning more money there.
Right.
Structurally speaking, there's not a ton of defensibility that you get, because essentially you need to hit a 4-minute wait time in a particular market to be viable. 4 or 5 minute wait time.
Right.
If a competitor can burn money to get to that 4 to 5 minute wait time, they're viable. Whereas with Airbnb, there isn't sort of an easy target you can hit. They need to have properties across multiple destinations, across multiple price ranges, across multiple quality, across multiple capacity. Some need to have Wi-Fi, some need to have parking, some need to have a kitchen. There's so many different attributes and criteria that you need to get get critical mass for. As a Even if they were a Series A, Series B company, the odds of a competitor trying to do that at scale were very, very low. So there was a competitor they had called Wimdu, which flamed out very, very early because they Airbnb had sort of good quality broad supply, whereas Wimdu had apartments in a couple of European cities. And so if you were looking as someone who wants to visit, I don't know, Milan or something like that, if you looked at the properties in those two places, you would go, yeah, I'm going with Airbnb. Even if it's a bit more expensive, it's better.
Hmm.
And that's basically it, because they have such differentiated supply, such unique and diverse supply. It means that a competitor has to get to critical mass across all of those different category combinations, which is very, very difficult. Whereas if you just need quote unquote drivers, it's a whole lot easier.
Yeah, that's true. Do you know of this classic competitor that Rocket Internet tried to create as a copycat of Airbnb, and they failed massively?
I think that was Wimdu.
Ah, that was Wimdu, is it? Okay. So I don't know which book I read, but it clearly gave a case study of if it was Wimdu, why it failed, and how Airbnb actually, because Wimdu, what it did was it just created inventory massively, but Airbnb was very organic, going one property at a time and adding and giving
Quality,
all quality, exactly.
quality, and diverse quality. That
Right.
was important.
Got it. Excellent. You mentioned something which again caught my attention, and since we would be transitioning into investing, you said it's important to keep yourself differentiated as an investor and build a brand. Could you shed some more light? Like, how does this why is this so important as an investor, um, and how is this adding value to keep yourself differentiated?
Well, the idea as an investor is, one, you want access to sort of the highest quality deals. Second is that the highest quality deals need to choose you. And the highest quality deals might not always be the most popular with investors. Sometimes they are, sometimes they're not. But you need to either find them or they need to find you. And two, they need to choose you to be on the cap table, right? So because of that, that's something that doesn't happen in public markets. In public markets, you just go and put money into company X. They don't really know or care who you are.
Hmm.
Whereas in early stage, that's not how it works. And especially at seed and pre-seed, where there aren't really a ton of established traction metrics, that sort of everyone is chasing. So once you get to Series A, Series B, there's only certain small set of companies that are out there, whereas the funnel is massive at pre-seed and seed. So there needs to be an avenue for these companies to come find you, or some sort of mechanism for you to go find them. Traditionally, the way it's worked in venture is you have this massive network of both other investors and founders, and they essentially identify and source deals for you. Now, that's great if, especially if you were early into venture, if you've been here since the early 2000s or sort of the mid 2000s, you've probably, if you were a good investor, you've built up a pretty good brand. And so founders know who you are and they've seek you out. If you're trying to get into investing today, uh, the pool of investors is significantly larger. Even with sort of the new macro reality and capital being a bit more scarce, there still is a very large pool of investors. So if a new founder who's just sort of had an idea and he's created his company in the last 6 months, if he wants to go out and source new investors, how's he going to do it? He's going to make a list of essentially brand name investors. He's going to ask people he knows. So essentially, he's going to come down to brand or network. And if you're trying to build a brand for yourself, it needs to be unique in some way, shape, or form. What makes you different? And it's very, very hard to be different today if you're a new investor who's a generalist. So it's always best to, at least at the start, carve out a niche for yourself. Personally, I'm a big believer that at pre-seed and seed in particular, specialist investors help because they're not just there and making introductions, they're actually helping you with key decision points with product and with growth. It's not that generalist investors can't do that. It's just specialist investors can really help. So Point Nine Capital in Europe is a great example, right? They've managed to build a great brand with SaaS, and they genuinely are helpful. And they have that brand. So if you're a SaaS investor, the first name you would have on your list is Point Nine Capital. Speed Invest has made a good name for themselves by having sort of specialized teams within. They've got a deep tech team, they've got a marketplaces and consumer team. So one of the first names you would have as one of the first fund names you would have as a marketplace founder would be Speed Invest. There's not a ton of specialist investors there. And so that goes for whether you're an angel or whether you're a fund. Having a very defined brand, that something that founders can associate you with, this is why you're the right investor for me, is exceptionally important.
Got it. So I was listening to this conversation with Dipali, which I think Timo was having, or Yuan, one of them. So we have a Upskillers as a podcast, which we plan to revive it as well. So Deepali was saying capital is a commodity. Everybody can give capital. What founders are looking for, not just money, they want the right investors at the right time. And I think this is what you are hinting at, because if you are known as somebody who has a certain expertise that can add value massively to that team, then the deals would automatically come to you. It becomes easier, isn't it?
Yeah, and also when the deals come to you, you're not sort of fighting for allocations. Like your allocation is secure. Other investors are fighting it out among themselves.
Oh, that's also valuable, isn't it? Oh, okay. So your deal is secured because they want you badly. It's not like on the
Yeah.
okay.
Yeah,
So
because you bring very specific value, whereas some other investors might not. They might have a certain sort of generalized brand, but they're not really sure what value add they bring. And so, if they were going to have a commitment fight it out, it would probably be there.
got it. I was watching Shark Tank of India. You know the Indian variant, right?
I've come across it.
And that's where, when there is a really good startup, and then there is this panelists, they would fight, because then they would start branding themselves that, you know what, I'm gonna make the right connections for you, or I'm gonna help you create that brand. And I think this is what, now I can make the connections, because each investor also needs to sell himself on what he can bring
Yeah.
to the table, especially when the cap table, when you're competing for that equity,
Yeah,
isn't it?
correct. Yeah, because even in this market, you do see oversubscribed deals, and when that happens, it's not the investors with the clearest value add are tend to be the most secure on the cap table.
Nice, excellent. This is aha moment for me. Let's talk about breadcrumb.vc. What is it about?
It's really a label for now that ties together everything I do. So I do three things mainly, right? So one is the Atomico Angel program, and I'm investing in pre-seed and seed startups with network effects. That takes up roughly half my time. The other half of my time is split between running the course on Maven, called Applied Network Effects, and the last bit is a little bit of consulting for early and growth stage companies, occasionally for investors. That's also about network effects. So breadcrumb.vc is really what ties everything together. That's one label. In practical terms, what it is, if you go to breadcrumb.vc, it's the set of essays that I wrote in the first year of the pandemic when I had an awful lot of time on my hands, and I basically wrote a book's equivalent of essays about network effects. And my course is basically built off of all that content I created in the first year of the pandemic.
How can one get to your course, by the way?
So you could go to course.breadcrumb.vc, or that'll give you a direct link to Maven, or just go to Maven and search for applied network effects. In fact, if you Google for it, also it'll come out. It'll be one of the first results.
Course breadcrumbs, right? And
Course.breadcrumb.vc, singular.
then VC. I'm just doing a Google search, and it gives me a list of homemade breadcrumbs. So
Which is why singular, singular.
okay. Oh,
If you
it's
search for applied network effects, that should take care of it.
okay. Let me do that live. Okay, so this is what I tried to do. And
Oh yeah, that would
course.
definitely.
This is the mistake. I did. Yeah. Okay. Course. Oh, okay. Great.
There you go.
Excellent. We are
So this
here.
is this is the very rough landing page I have. If you click on learn more, that will take you to the prettier landing page that Maven has.
Nice. Yeah, I know of course, Maven became hugely popular. My sister runs a TikTok course on Maven, so that's how I know a little more. And then, and you, how long is the course, by the way?
It's 3 weeks. It's 2 sessions per week, and the time commitment is roughly 6 to 8 hours a week. Each
Nice.
session goes on for about 2.5 hours, and the way I run it is the first session is one set of concepts about one type of network effect, and the second session of that week is, all right, you know those concepts. Here are three companies. Tell me what you think, which tends to be a lot of fun for me.
Got it. And the target audience, as you mentioned here, is
It's
founders,
yeah, it's
investors, and
Yeah, so it's three sets: founders, investors, or if you work on product or growth at a tech company, or at a company that is network effects aligned, you'd probably find value in it.
got it. And you talk about properties, monetization, liquidity is something that you mentioned already, virality and stuff like that. This is massively valuable. Excellent. Thanks for sharing that as well. Um, you mentioned about your three engagements. Tell us a bit about Atomico. I've been hearing a lot about Atomico. Maybe what is Atomico?
Atomico is a Series A and beyond venture capital firm. It was founded by the founders of Skype, Nicholas Zenstrom being sort of the key person there, and so they've been pretty early in the European venture game back when nobody actually took European venture seriously. And their aim for the Atomico Angel program basically is partly it's to create new uh, a new generation of investors essentially.
Hmm.
So a lot of people on the Atomico Angel program were folks in the tech ecosystem who hadn't really invested before or didn't really invest seriously before, and essentially give them uh, a platform to invest, either professionally or semi-professionally.
Hmm.
So the way the program works is almost uh, like a little fund. So you get an allocation to yourself, and you get a 25% carry on the investments you make on from that pool. So not very different from Atomico being an LP, and it's a pretty hands-off relationship. Once you have access to the capital, we write up an investment memo and submit it, and the cash gets wired to the startup. And Atomico doesn't really kind of say invest in this, don't invest in that. There's very sort of broad ground rules. It's invest in European startups, don't invest in gambling, drugs, and porn. That's about it.
And how much is the capital usually they offer to?
For someone entering the angel program for the first year, it's 100K USD,
Mhm.
and they also have this alumni program. So angels that have made that have been active under the program. So I'm currently a part of the alumni program, where you get a little bit more capital to go and deploy over I think a 2-year period.
Got it. Help me understand how this ended. This is also called a scout program, isn't it?
Yes, but the term scout program tends to have two connotations. So sometimes it's this, which is a scout fund. Sometimes it's a scout program where you as a scout go and source deals and send those deals to the VC fund, and if the VC fund invests, then you get some sort of benefit from it, either carry or a sort of a cash bonus. So scout program is a bit more of a hazy term. It includes both. The angel program definitely means this.
Got it. So why do big VCs have such scout programs? Is it because there are VCs who do a minimum of 20 million or 30 million, stuff like that? Is it to not lose out on opportunities that could be bigger? So that's why they delegate this to scouts, or what is the bigger motive behind VCs running angel programs?
Well, more than anything else, it's probably visibility, right? Now, Atomico, for example, mostly does Series A and beyond investing, right? So that I think they've only gotten involved in uh, rounds like 5, 6, 7 million and plus. I think that's probably GBP. Um, but essentially, they if every VC firm needs a pipeline of companies that they want to look at in the next year and the next year and the next year. And pre-seed and seed tends to be the zones where the top of the funnel is largest, because founders can come from anywhere. It's not just second-time founders or well-known founders who are creating great companies. It's completely unknown first-time founders as well. Mark Zuckerberg and Evan Spiegel, as two sort of wild-ass examples, are
Right.
folks that built massive companies and came from practically nowhere, right?
Got it.
And so you always want to keep an eye on what's happening at earlier stages. And so the angel programs, or scout programs, or angel programs in particular, are a good way of keeping an eye on what's happening in the early stage ecosystem. There's no sort of signaling risk or commitment there, because this is not a relationship with the fund. When I make an investment, I am managing the relationship. I am essentially the fund manager. If there's a whatever advice would need to happen, whatever communication would need to happen, would happen via me. And at any point, if Atomico sees that company XYZ is becoming interesting. Oh, by the way, they've got this angel on the cap table. He's our angel. That's an easy way to get access to that company, right? Um, and so it opens doors. It provides visibility more so than anything else. Whereas a scout program basically generates deal flow for what the fund is investing in right now. So if they have a scout who's focused on healthcare investments, Scout X would source a particular deal, bring it to the fund, and if the fund invests, the scout, let's say, gets 5% carry in that deal.
Got it. How do they look out for say new investor? You said a new investor would get 100K capital.
Mhm.
What do they look out for in a potential new investor that they would want to give money?
I think generally I've seen 3 or 4 sort of archetypes of folks that fit. One is a community builder, right? So you've created a community with a specific theme. Deepali is a perfect example of that, right? So she created Alma Angels. She had, because that community, she had a great brand as someone who backs female founders, and also had a very strong deal flow of female founders, thanks to the community, right? So that was one archetype, because community builders tend to be very deeply entrenched into the ecosystem. The second one is someone essentially who's a builder. So a founder or someone who works in product at a great company, because founders tend to seek out other builders when they're trying to build something sort of in their area or in their zone, especially if they're deeply entrenched in the ecosystem. Third, I would say, are essentially someone who has domain expertise in a particular area. And so similarly, if you have domain expertise and you're in the ecosystem, odds are that the founder would seek you out when they're building something in your domain.
Hmm.
So those are essentially the 3 broad archetypes you would see. And so the way they find them is very similar to how everything else happens in venture, which is personal networks, which is, okay, who do they know? Who do they know? And who do those people know? And so at one point, there's a submission form of where existing angels put in names of people they think might be interesting. And then Atomico also looks at other folks who they might know themselves, and then there's this massive triangulation exercise of are there any biases that they've got? Do they have coverages across multiple regions, across multiple work verticals, across multiple specializations? And so once you have all of that, then you kind of get a final list of what it looks like.
Got it. And do they have full autonomy once the money is granted, or do they need to like validate or get it reviewed on where are you
No,
making your investments?
no. So the only sort of validation is certain sort of documentation that needs to be submitted along with the deal, and in an investment memo. I've never had a case of you can't invest in X because we don't like it.
Okay.
The only thing is you can't do Series A deals because whole point of the angel program is pre-seed and seed. So if you're going sort of too far outside that, then it would be a no. But outside of that, there's no real uh, requirement. It's really what your thesis is as an angel, what you like and what to invest in.
But that wouldn't that be a little riskier, especially somebody who is new, or is that some a risk that they're willing to take
Well,
to
that's the point, right? I mean, there's no way to avoid risk in at pre-seed and seed investing, and so sometimes angels, especially with the first time when they're starting out, if you don't really have a focus area, it can be a bit difficult because then you're trying to dabble and figure out where you want to go and how you want to support these founders. So some folks are especially good at sort of getting over that very very quickly and finding a niche or something like that. And yeah, I mean, at the end of the day, everything has a power law. VC funds have a power law, startups have a power law, and I assume angels would also have a power law in the sense that there's an awful lot that are going to try it out. Some of them are going to stick with it and be good with it. Others are probably a lot of angels might find other avenues that they like better. Not, I would say angel investing is not for everyone. It's 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 a lot of work. It takes an awful lot of time, and if you're an existing founder, sometimes it can be really really hard to commit that time. So in my case, I'll give you an example. I've made 7 investments so far, including one I'm trying to close right now. I've looked at 472 deals so far. It's probably not a huge number for a VC firm, but for an individual angel, that's a lot of deals.
Did you say 47 or 470?
472. So I'm not talking about, I haven't had 472 calls, but those are the deals I've evaluated. So I have a deal flow sheet where I track all the investments I've passed on, all the investments I've made to make sure that whatever, if something I've passed on turns out to be huge, there's probably some learnings in there for me. So it's important to track it. So at least in terms of what I've tracked, it's 472 deals.
Got it. So many questions coming to my mind. You talked about angels supporting founders. So is this a requirement? Like there are passive angels as well, isn't it? Like so, or does a definition of an angel needs to be actively involved with the founding team, helping them out and giving them support?
I mean, from Atomico's point of view, or from any VC firm's point of view, when they're running an angel program, it's really up to the angel. It really depends on how you want to go do this. And so, if you have a really, really established brand, a really clear brand, and sort of you're comfortable just putting the money and sort of sitting back, that's perfectly reasonable. If you're someone who's sort of still emerging in the ecosystem, odds are you're going to need to put in a lot more work to get there, and so it's becomes harder and harder to become to stay as a passive angel while also getting access to great deals and getting on the cap table of great deals.
And but if you have a wide portfolio, there is again you do not have the bandwidth to be active to all, isn't it? So you have to
Yeah,
be
that's true. You have to pick and choose your time, and so this is where again Atomico gives you a lot of leeway as to kind of how you want to construct your portfolio. There is a minimum ticket size. I think you can't go below 10K USD or something like that, and so there's a maximum as well. So you kind of figure out how you allocate your time. In my case, what the sort of comfort zone I've fallen into is I can do 5 to 6 deals a year. That's high conviction deals. So that gives me enough time to allocate that gives me enough space to allocate some of my time to each of these companies, at least the ones that feel like they want to opt for that. So every time I invest, I tell the founders, look, I have the option of I can give you an hour a month and we can go through what metrics you need to measure, what needs to change on the product, how growth is going and stuff like that. And it's up to you whether you want to take it up or not. But on average, that's basically what I end up spending across each company. If when it's a pre-seed company, it tends to be a bit more. When it's a seed company, it tends to be a bit less because they have more resources. But yeah, there's always exceptions in cases where you've gotten so close to the team where you want to continue supporting them as they grow. But yeah, I think 5 to 6 companies a year I should be able to manage, because the idea is, as things progress, some companies will scale to Series A, Series B, and they will not need as much help from you. Some companies will unfortunately go bust, which is what happens in startup land, and so there's no avenue for you to support them anymore until the founders are off to their next thing. And so odds are that time commitment will even out.
Got it. You mentioned about power law. Could you explain what did you mean by the power law?
I mean, broadly, it means that a small percentage of companies are responsible for a large percentage of returns. So in pretty much in any venture funds portfolio, it's always 1 or 2 companies that are really massively driving the returns. That's true for angels as well. That's true for venture funds as well, in the sense that's why they talk about the top quartile VC firm. Those firms are ones that actually have good returns, and the vast majority of the VC industry does not actually have great returns. But that's fine, because as an LP, if you're investing in VC as an asset class, those top performers are going to make up for the others. And so you will see that in angels, in sort of individual startup investments, in venture funds, that tends to happen in the early stage ecosystem.
Got it. So since we have broached the topic already, for angels who are making their commitment, especially I was having a chat with Yuan. I was asking him, okay, could you let me know how many deal flows you expect in the next year or so, because I need to plan my finances, because there's no point is in only investing in couple of deals, right? Because that is too risky. What is a good portfolio? How many portfolios one should have to de-risk yourself? Some say 20, some say 40, some say 50, because as you said, there are always this power law, right? So there are
Yeah.
always this few of them in
Yeah.
your entire portfolio, which will make up for the rest massively. So what is there a rule of thumb? Is there any frameworks there?
I don't think there's a right answer there. It's obviously there is a minimum number, but you've got 2 broadly different approaches here. You've got sort of the Kima Ventures approach, which is to invest in almost every credible deal and essentially have a high volume portfolio, right? They've done 100 plus deals, 100 plus portfolio companies. So with that sort of model, you're not really banking on value add. You're sort of banking on, you give a little bit of money across this large portfolio. Some of them are going to take off. You provide sort of some value add in terms of connecting them to the right people when they need help. That's about it. And that's a completely viable strategy in the early stage ecosystem, right? The other strategy is concentrated high conviction bets in a handful of startups where you can actively support them over time. That's the one that I follow. It doesn't necessarily mean it's the right one, but it is one of the right ways to do it. So you've got in the US, Benchmark, for example, is one that follows that model. So they don't make high volume investments. They make a handful of bets each year, and they sort of build and support those companies. And so that's the one that I subscribe to, but it's not the only successful model. So Kima Ventures here in Europe is sort of a pretty good example of someone that's done those sort of a much broader portfolio. I think Calmstorm also does something like 100 plus investments a year or something sort of in that vicinity. So both models work. I think you can't do something in the middle. That's when you sort of run into trouble, where you're sort of semi convinced about what this does, but you still want to do like 40, 50 deals a year. That's where you run into trouble. Now, in the grand scheme of things, over like a 2 to 3 year period, I think you certainly need to have more than, let's say, 15 companies, right? So if you're doing 1 or 2 companies a year, I think that might be a bit of a problem, where sort of the power law might start working against you. But if you're doing 15, 20 companies over a 3 year period, I think that's reasonable. People say it's 20 companies, but 20 companies doesn't mean much by itself. It also means what time frame. 20 companies a year is still quite a lot, whereas 20 companies over 3 years is a fairly constrained amount.
Got so when you said high concentration, high conviction, where does conviction come from? What are the factors that are crucial for you to invest in a company with high conviction?
So for every investor is different. So for me specifically, what I'm looking for is one. So when I initially speak to the founder, what's their relationship with the problem, right? Why are they going after this specific problem? Sometimes great companies can come from founders just thinking, I want to start a company, and they ideate and come up with the market. But it more often happens when uh, the founder has a relationship with the problem. There's a saying that says that founders need to be missionaries, not mercenaries, and you're much more likely to be a missionary if you have some sort of personal relationship with this problem, that you really want to solve this. So even when things go bad, you're going to keep sticking to it. And I can see that in some of my portfolio companies, even when things are sort of when shit's hit the fan, they're plowing through it. And sometimes you wonder how they manage to do it, because I would probably drive myself insane in that scenario.
But I've thought through this. Sorry to interrupt you. I've thought through this. Sometimes it becomes, I mean, fake storytelling as well, because you want to make it look good
Yeah.
on a pitch deck. And I also look at the other thing, which is other aspect, which is fair. Like, as an entrepreneur, if I look at a problem which is a great opportunity to solve, it might not be, I'm not deeply resonating with it. But if I can, it's like, if I see that, okay, there is garbage problem in my town, and if I resolve this garbage problem, I'm gonna make ton of money. It's high value, but I do not resonate. This is not my life's mission. Okay, so this is other aspect of it. But do you not give it equal credibility?
I mean, that's fair. So I'm not saying that I would say no to a founder just because they don't have the personal relation to it. It's just a very positive signal in my mind, assuming sort of it seems authentic and it's not like a made up story, which is kind of sometimes is hard to tell. Some founders are really really good at weaving a story, right? Um, the reason I say that is because building a startup is a 7 to 10 year journey, and it's not linear. It's not going to be all sort of roses and sugar and roses, or whatever other term you might want to use. Odds are at some point you're going to come to a life or death situation. Odds are at some point you're going to run into a fundraising difficulty. Odds are at some point you're going to need to lay off employees. So the question is, how do you respond in those scenarios? If you don't really feel closely tied to the mission of this particular company you started, will you be able to push through those hard times? And so that it's not sort of network effect reasoning. It's just sort of it's a very human reasoning. And so that's really where it comes from. It's not that the market potential isn't great, or these can't be huge businesses. It's just kind of what happens to the human element of the founder when you hit those points, and when you don't really deeply believe in what you're trying to do. That's the challenge. So that's sort of the one piece of it. Once I sort of got that out of the way,
Yeah.
the first step for me is, okay, I need to have a very, very deep understanding of this interaction. So can the founder explain this interaction to me crisply, neatly, in sort of a couple of sentences?
Understand interaction, did you say?
Yeah, I mean, every network effect based business is based on an interaction between two users, whether it's the same type of user or different type of users, right?
Got it.
Right. And so can you very clearly explain to me what that interaction is? So essentially the user journey of one user coming in and completing the interaction with the other user, and why that's better than existing alternatives. Right. Now, when a founder does not have a good enough idea of what the interaction is, and they can't basically explain it to me in a couple of sentences, I mean, imagine how are they going to explain it to a user? Like, what is the user supposed to do? So that's a huge red flag to me. That's at that point, that's the instant no. Right. So especially for a network effect based business, it's exceptionally important. You can't just come in and say, we want to, I don't know, raise the world's consciousness or something, the WeWork approach. It doesn't really work with network effect. You need to have a very, very specific, deep understanding of what the interaction is.
Got it.
So I mean, most of my first calls tend to focus really on those two things. There's lots of follow-up questions that come out based on what they've told me about the interaction. But essentially what I'm trying to do is then assess, based on my understanding of network effect, how scalable is this? How defensible is this? What challenges are they going to face longer term? And at that point, it's okay. I've understood the interaction. I want to study your story. I'm sold on those two. Next, I want to see how well is the interaction working so far. And so for this, you don't need to have thousands of users. Even if you have a small set of 3 or 4 customers, if you're a B2b company, a few hundred users, or even 50, 60 users if you're a B2c company, it
Right.
can be enough data to give you a signal. So when I see those early engagement and retention metrics, it tells me whether the early users are finding value in this interaction, and as more users come on, is it increasing the value of the product for all users? If
Right.
that's not happening, it's a no. Even if I'm sold on the interaction, it seems like a great intuitive idea. Implementation wise, it doesn't seem to be working. So something is broken. If they were a portfolio company, I would spend a lot of time with them to figure out what's broken and how to fix it. But since they're not, I don't have to do that. I'll just tell them this metric. Generally, what I do is when they share the metrics with me, whatever I do with them on a Google Sheet, I'll share it back with them, so they have a clear idea of why I'm saying no. This is exactly why. And so if down the line, if that gets fixed, come back to me and we can have another chat. So broadly, that's about it. That's how I get to conviction. Obviously, there's references as well, which is sort of non-network effects. Everyone would do that. That's for me to get a sense of how the founder likes to work, what their strengths and weaknesses are. How can I actually help them? If obviously there's a very, very big red flag that comes off in the references, that's a challenge. But otherwise, that's basically how I build conviction. It's not a very complicated process. And I'll also emphasize, when you're making pre-seed and seed investments, especially for a network effect based business, growth and traction is not a signal.
Is not a signal.
Is not a signal. A lot of times, and I've seen some sort of generalist VCs do this, where they've kind of pushed a company to grow, and so the top line sort of looking very, very good, and then you look at the retention and the engagement, and it's like a line that's going straight down. And that's very, very bad, because what's going to happen to this company essentially is their trajectory is going to do this. And those are the saddest companies, because clearly if a founder was able to pull off a trajectory like this, there's something to the founder. But either because he's received bad advice or he hasn't seeked out the right advice, he's made a different set of choices, which is going to make it very, very difficult for him over the next 6 to 12 months. And so those things are you really need to watch out for. And then the last thing that is a complete non-signal and is borderline sort of hilarious is a 5-year forecast for a seed stage startup. I mean,
do you still get pitch decks with 5-year forecast?
Oh yeah. I mean, I'd say half to 70% of the pitch decks I've seen have one of those in them somewhere. And look, it's not that your plans for the next year don't matter. What matters is your milestones for the next round, right? What do you need to hit for the next raise to basically de-risk yourself for the next raise? That's what matters. And of course, your assumptions, how you're thinking about growing, what growth channels are you going to use, what sort of CAC are you going to have, all of that stuff is important. A 5-year forecast is not important. And sort of those milestones aren't necessarily revenue milestones, right? For a social media company, it could be a user growth milestone. It could be a milestone of number of transactions if you haven't quite figured out what the take rate or monetization model is for the marketplace. These are fairly normal issues for early stage network effect companies. Sometimes in the European ecosystem, we're a bit conservative, and so we tend to discount companies that aren't monetizing at sort of pre-seed or seed, or don't have clear line of sight to monetization. But I mean, think about it. If you followed that approach, Facebook wouldn't have gotten funded.
For 10 years, did not have any profits. Yeah.
I mean, you need to. There are companies, especially those with network effects, that are going to follow that model, and it's going to be successful. So if European investors don't fund it, the US ones will. I think we're seeing some progress on European VC. I think it's getting a bit more sophisticated, but I think there needs to be more movement there.
Got it. So according to you, is retention one of the most important metric to look at?
Yes, retention and engagement, and I'll say sort of both, because you can have situations where retention initially is low when you have sort of a user base of 100 million. But let's say you've defined what the core action is. A user has to create a post. That's generally what happens, and other people react with it. And you see that the number of posts per user are going up as you've gone from 100 users to 500 users or whatever, and the retention at that point is not exceptionally high. But that tells you that directionally your retention is going to go up, because cohort on a cohort level, your future either your future users are more engaged than your previous ones, or your users are getting more engaged over time, or both. And both of those will have some sort of an impact on retention. So that can be a leading indicator for retention. I will look at retention, because if the retention is high, I mean, that's an easy yes, right? But even in cases where retention is not high yet, if you're seeing that sort of pattern in engagement, that's a very, very good signal.
Got it. So are you only sticking to companies with network effects, or you also do some investments on non-network effects
No,
startups?
exclusively network effects. I mean, I can do. Look, I have the capacity of 5 to 6 investments a year. If I go invest in a, I don't know, deep tech, health tech startup, I have absolutely no idea how to help them, and it's taken up capital that I could have allocated to a startup I actually could have added value to, right? So it's that's a deliberate choice. It's partly interest, partly uh, thesis in terms of where I think uh, you have companies that are highly scalable and defensible, and also partly just realism of how much capital I have.
Got it. You mentioned reasons for high conviction. You did not mention about team, the founding team. Uh, would that be a qualifier for you as well?
I mean, that's where the relationship with the problem comes. I will never say that a founder needs to have X background for me to back them. In fact, usually, especially if you're creating, there's a elegant chart that NFX has, the VC from Silicon Valley. They've gone that the ideal experience for a B2C founder is 0 to 5 years, because at that point you're naive enough to think up certain solutions that someone more experienced just would not think of.
Mm,
If you're a B2B founder, you probably need a bit more domain expertise. So at that point, I'm kind of thinking, what sort of background you've got in the space. But even there, I'm not heavily background dependent. Look, I'm not investing in deep tech AI stuff, right? So I don't care if you have a PhD
curse of
or
knowledge, isn't it? The curse of knowledge.
yeah. So I don't care if you've got a PhD. I don't care if you've worked in, I don't know, Ericsson or Siemens in R&D or whatever. Those would be relevant if someone's investing in deep tech. I don't do that. Since I'm investing in network effects, the quote unquote background of the founder doesn't really matter. Um, I've invested in folks a couple of years out of college. I've invested in folks that have a track record of doing crazy viral projects. I've also invested in folks that have had a reasonable amount of experience. And at least so far, like NFX, I would say that I haven't really seen too many patterns there, except that if you're doing something B2C, younger is better.
Got it. So I'm sure you have had bad decisions as well. Maybe you passed upon opportunities that you thought would fail, but they eventually succeeded. Could you give some learning lessons from your past experiences?
Now, part of the trouble with that is that I've only started angel investing in earnest early 2021. So I'm
Mm,
not sure I have enough data. But
got it.
I'll give you the example of one company that where I was sort of trying to get in. I lost the deal, but I was sort of not. I was a little bummed that I lost it, but I didn't think it was like an earth-shattering loss. And this is a company called No Unity, based out of Germany, which was building a social network for sharing notes for high school students.
Mm,
And they just raised like a 12 million Series A. They're the number one education app in like 5 different countries, and I'm definitely not happy to not be in that round. I wish I was. I was
you,
still trying.
you passed up that opportunity.
No, I didn't pass it up. I was trying to get in, but I lost that deal for sort of a combination of reasons. But it also was not something when I lost it that I was sort of very, very down on myself for losing it.
Ah,
But
I see.
I should have been more down. Well, again, I've only got so many data points so far. I'll probably have a lot more in the next 2 years to share, where
Got it.
I've sort of passed on deals and that company's turned into the next unicorn.
Got it.
So I'll put a pin in that one.
Got it. So in programs like Atomico, does it is it important to maintain your reputation? Like, say, for example, they took a bet on you, they gave you 100K USD to spend. Uh, is it important for you to succeed to be able to get more in terms of, as you said,
I think Atomico is pretty open that way, in the sense of they're cognizant of the fact that over 1 year you only have so much of a track record you can build up. There are cases where you've got a very strong track record in a year.
right,
There are cases where you don't necessarily have a strong track record in a year, but you still they still give people money in those situations as well. I think what they're looking for is someone who is very engaged in actually deploying the capital. And so if you can do that, then you will get access to more capital, because from the perspective of Atomico, what they're trying to do is democratize access to funding and access to angel investing, and
mm,
also increase their pipeline of opportunities, right? So if anyone who's going out actively investing and sourcing deals, that fits the program.
got it, got it. Excellent. Do you have a preference between B2C and B2B startups?
Not specifically. Uh, Anecdotally, I've noticed that B2C founders tend to be more aware of network effects, and B2B founders, on average, are less aware. And so my portfolio is heavily skewed towards B2C. So of the seven, five are B2C and two are B2B. But that's not a deliberate choice. It's just a function of kind of what I've seen and what I found interesting. My most recent deal was a B2B deal. Fundamentally, I don't think the way you evaluate the network effect doesn't actually change. At the end of the day, you're looking for what the interaction is, how well that interaction is working, and that's pretty much it. And of course, evaluating at scale how scalable or defensible this is. But whether the company is B2B or B2C doesn't affect any of those things. How you implement it and execute on it changes, but none of those fundamental factors change. So the way I advise them also doesn't fundamentally change, and the way I work with them doesn't fundamentally change, whether it's a B2B or B2C company.
All right. If all factors were to remain constant, would you rather invest in a B2B or a B2C? Like both
I,
were network effects, both were yeah. So all the high conviction check
mm,
boxes are ticked. Which one would you go for? Like
I'm gonna cop out and say both, because if it checks off everything, then I have no reason to pick one over the other.
yeah, the
So
reason the reason I ask is I was listening to this conversation with Peter Cowley. This is again upscalers podcast, and Peter mentioned that the reason he has massively skewed all his investments are B2B is because consumers do not understand value. Businesses understand the notion of value. So I mean, I did not dig deep into the nuance of what he wanted to say there, but did you understand what he wanted to say there?
I think what he's trying to say is economic value is more concrete for businesses versus consumers, where consumers it's more amorphous. So I can see that if you are essentially selling something to consumers versus selling something to businesses, the flip side of that is that businesses tend to be a far more margin conscious than consumers are, and especially if
Are
you're sort of
you, I mean, I thought it's the opposite. No,
margin conscious. When I say margin, about their
I,
margin specifically. So
I see.
especially about their margins. So for example, if you're doing a B2B marketplace versus a B2C marketplace, the take rate discussion is a whole lot easier in the consumer marketplace because it's
Okay,
value being given for them. Whereas in a B2B marketplace, the business is going to be cognizant of, okay, this is the take rate I'm giving. How is that affecting my margins? Right.
got it.
So that that's always two sides of a coin. I don't think that's a clear cut decision. And then again, on the consumer side, there's lots of different ways of monetizing without charging the end consumer directly.
Right.
And so despite things like advertising getting a bad rap of late, at the end of the day, it's a viable model because you're giving free services to consumers, and there's still a ton of potential there.
Got it. We are ending towards the end of this conversation. Um, what advice you have for new angel investors? So you are a full time investor. The new angel investors often have a day job, and then they try to invest on the side. But
Yeah.
there are many passionate angel investors who would eventually want to make it as a full time
Yeah.
investor. What would be your advice to to learn, grow, and make this transition?
The first and most important one is find a niche and a distinct brand. Um, there's even today, even with the market the way it is, there's still an awful lot of angel investors out there. So essentially, for deals to find you and for founders to choose you, that part becomes really important. Ideally, find something that you are passionate about. It's very, very hard to build a niche, and sort of build a specific brand when it's about something you don't really care about. So it's sort of very similar to the missionaries, not mercenaries discussion that we had about founders. So find something you care about that you can also add value with, um, and that can differentiate you as an investor and give you a unique brand. If you do those things, I think everything else will take care of itself. After that, all you need is persistence and being competitive and sort of having a chip on your shoulder. Those things, I think, are, if you have those personality traits already, those things are easier to manage. The brand bit is something you might need to do a bit more conscientiously.
Okay, just those two.
I mean, to start with. Second is obviously find a way to evaluate companies. And everybody's got a different way. Depending on kind of the niche you have, you're going to have different bets. So like the way Dipali, who focuses on female founders, evaluates a company is going to be very, very different from the way I evaluate a company. We will talk to each other because I take notes from her because I'm learning something that I didn't know. She's going to take notes from me because she's going to learn something from my approach. But sort of you have your core approach, and some of that you'll basically have to test, because if you're doing this for the first time, these are essentially rules or sort of frameworks you're creating for yourself. You can borrow ones that are out there, but you basically need to make them your own and see, be conscious about what works and what doesn't. The good thing about angel investing is that you have really highs and you really high highs and really low lows, and so learn from the lows and sort of don't get too high with the highs. And and then I guess the rest is just persistence, continuing to do it over long. It's very, very hard to do this over 6 months or a year. It's a multi-year process.
Right. And what should be the rationale for becoming an angel investor? Is making money okay to be the grounding
It's
foundation?
probably a very bad reason to become an angel investor because there's a saying that angel investing is a very, very expensive hobby, and for the vast, because of the power law, for the vast majority of people and for the vast majority of startups you're dealing with, it is going to be a very, very expensive hobby. So if you're doing this only for the money, there's probably better ways to make money, and there's probably better ways to make money sooner, because you will not see your money for 7 or 10 years in the best case scenario. If you're seeing money in 1 or 2 years, and the startup probably didn't do too well anyway. And so that you need to have an innate sense of motivation that is beyond money, about some sense of mission that leads you to do this, that leads you to persist, even though there are no exits on the horizon for 7 years, 10 years. Even if you do see a company is doing very, very well, you do know that, I mean, over a 7 to 10 year period, anything can happen. And so, yes, it would be great at that point when the returns actually do come in, and then you can establish yourself not just as an angel investor, but as an investor who's driving returns, raise a fund, stuff like that. And maybe that doesn't take 7 years. Maybe that just takes 3 to 5 years, but it's still fairly long term. When you're starting in, you need to have some sort of mission.
Right.
I think the stronger that mission is, the easier it makes everything else.
So there are again two options, right? So if you are really mission oriented, you would rather want to build something of your own, okay, build your own startup, than be an investor in startups. How do you make that choice?
I mean, it depends on what the mission is, right? So if the mission is to solve a very specific problem,
Yeah.
in some cases, yeah, you'd be much better off starting a company. But take Dipali's mission of uh, making sure that female founders get more investment. I mean, that's not really something you can solve with a company. You could solve that with a fund potentially, and maybe angel investing is a path to that. Or now she's a partner at Speed Invest, so that problem sort of takes care of itself. So she's now able to direct more and more funding towards female founders. So it's the angel to VC path that she's done that's helped her with that mission. In my case, my mission is essentially to preach the gospel of network effects, if I had to, if I had to put it in sort of a pithy comment. And it's very, very hard for me to do that from within a company. If for me to found a company, I would need to not just believe in network effects. I would need to believe in a very specific problem that is solved by network effects, enough that I am willing to give up looking at other sorts of companies and looking at where else network effects could apply. And so far, I've never come across that. So I basically carved this path out for myself because that's what feels closest to the mission that I've created for myself.
Right. So I'll give a rationale that I just had last few days. I mean, you let me know if there is a flaw in this rationale. So I'm passionate, and I feel that if I ever build my own startup, I will give everything. But then I also feel that if I am giving everything to that one startup and knowing that 90% of the startups fail, I would rather diversify and invest in a portfolio of startups than build my own startup, because then I'm only building my own startup, and that is heavily um, that is heavily. I mean, it's not, in all likelihood it would fail, right? Um, I also understand that founders do not start with this intent. Founders start with hope and possibility. But is there a flaw in this rationale that okay, one should be an investor, because if you build your startup, you're just building one startup, and there's no guarantee that you'll succeed.
I mean, I'll give you sort of a generalized saying that I've heard, which I think applies in here, in that diversification is very, very good for wealth preservation. It's not very good for wealth creation. Whereas if you want to create wealth, you need concentration.
Mm,
Uh, and I think that applies to sort of essentially this time. If you're a founder and you're sort of going into your idea, sure, I mean, sure, there's nothing stopping you from going and investing in other startups. But if you see that as a way of diversifying your risk uh, of doing your startup, I think I think being a founder isn't necessarily the right role for that person. You essentially need to be all in, mission oriented, like this is it, this is the problem, and essentially eliminate all other options to the point where this becomes your core reason for being. And uh, and I think that is I mean, of course, that's not the only thing you need. You need lots of other things to go right before you can build with. But I do think you need that kind of a mindset.
got it. Excellent. Last question here. We all hearing about the impending recession, stagflation, they say as well. What do you make of this coming phase?
I mean, I'll give you sort of two on. I'll caveat my answer. Right, the caveat is that I'm not uh, a macroeconomic specialist, so I try to spend less attention on that, because whatever predictions I make, they're probably going to be wrong. I've learned to essentially stay within my lane. So I'll be curious about other things. I'll read about things, but I'm not necessarily going to make long-term decisions based on those things. That said, um, I don't necessarily see a dot-com style collapse happening within tech, because right now you've got companies that have real customers, that have real businesses, and yes, the valuations of them were inflated over the past year, but they still have real customers and real businesses. Those aren't going away. There are, of course, some companies, like the WeWorks of the world and the 10-minute grocery delivery companies that probably did not really fit that bill of having sustainable business models, and so some of those companies are going to go out, thankfully. But the vast majority of tech companies at scale, I think, it'll be a bump in the road, and then it'll essentially normalize. Is what I think. I mean, but then again, you also have the crypto world, right, where I think the .com comparison applies more a bit more, in the sense that utility is still questionable. There's an awful lot of a lot of it is built on speculation, and this tends to happen in sort of the early cycles of any new or tech era. So I think if there is potential fallout, it's probably likely to be a bit more severe there. So the crypto tends to have these sort of boom cycles and then what they call crypto winters. And so the likelihood of, I think, a crypto winter is exceptionally high. And so I think there's a lot more pain over there, but I think that pain is healthy because it drives out an awful lot of speculators and evangelists and folks who are talking about, you know, very broad ideas without actually being specific about what it solves. And it leaves folks who are serious about building a real meaningful product for real people. And I think that's good for the ecosystem.
Right. And what would you suggest angels to keep investing?
I mean, look, downturns are the best time to invest because there's not massive wars over deals, valuations aren't getting inflated. Uh, Again, building a startup is a 7 to 10 year cycle. So,
Hmm.
if you invested in year two of a startup in a 10-year journey and that year two happens to be a recession, does it matter? Not really. I mean, part of the problem, though, of course, is that if you're an angel that's investing personal capital, and a lot of your personal capital is in public markets that have collapsed, you have less capital to invest. So that is unfortunately a very real situation that happens with LPs for funds as well. So in that case, it can be tighter. But I mean, if you have access to the capital, there is no reason to slow down just because, quote unquote, the market has slowed down or there is a recession out there. Companies are being built every day. If you see a compelling company, if you have conviction in the company, there's no reason why you shouldn't invest because of timing.
Would you give the same suggestion to founders that because I heard that founders will slow down, they will go back to their safe jobs and come back when the environment is better.
I mean, the thing I told you about crypto evangelists, I think applies here as well, in the sense that if you were a tourist founder who was building a company because it's easy to get funding, those aren't really the right founders to invest in anyway. The right founders to invest in are who are doing this because they deeply believe in something, and so
Mm.
they will build whether the market is bad or the market is good. Those are the kind of founders I'm looking for. So in general, the signal to noise ratio on the founder end also improves dramatically in situations like this, which is even better for angels.
Is there a term tourist founder or is this your making?
Here's mine.
Tourist founder, good one. So in the last few years, where the valuations were touching the sky, there were a lot of tourist founders because because they just joining the bandwagon, right?
I guess, yeah, because it's if you're an MBA, you're working in a consulting job, you're an investment banker, you see all of these founders raising large amounts, feels like, yeah, I want to do that.
Mm.
And so you actually the more accurate term, I guess, would be a lifestyle founder.
Lifestyle.
That's a term that actually used. And so you have more and more lifestyle founders in sort of market environments that way, and they tend to drain out when market environments get tougher. Investing, getting access to investors gets harder, and so what's left are the real builders. Or at least on average. I'm not going to say that that's the case throughout, and that every single founder is sort of an exceptionally high quality founder. There is the power law at play again. But in general, in terms of the signal to noise ratio, it tends to vastly improve during down markets.
Excellent. Well, this brings us to the end of a fascinating conversation with Samir. Samir, this was like lots of aha moments, very intellectually stimulating. Especially, I get a high whenever I'm learning something massively, and this conversation was a journey of learning for me. Thanks a ton. On a weekday after a day long work, you gave me this time. Cannot thank you enough for this.
Thank you for having me on, Ravi. I really enjoyed the conversation. Intellectual conversations are always fun. And so ending the day with one of these just sort of helps me relax.
Excellent. And if people were to find you, how could they reach out to you?
Depending on kind of how they want to work. If you're trying to pitch a startup to me, just email me at samir@breadcrumb.vc. You don't need a warm intro. I'm completely okay with cold inbounds. Half my portfolio is cold inbounds. If you want to take my course, just Google for Applied Network Effects. The landing page has the application form and all the info you need. And for anything else, just sort of follow me on LinkedIn or Twitter.
Excellent. Thanks again, Samir.